Hello my fellow freedom builders and welcome back to the channel. Today's video is about interest rates and a bit about inflation. I get a lot of questions in the area of where do I think the interest rate is going? Is it going up, down, how quickly, when will it happen, and so on and so forth. Let's first make it clear, I don't have a crystal ball. However, I do have a lot of historical statistics and therefore I have an idea. And of course, both the Fed and the ECB, the US and the European Central Bank, have given us some very clear indication as to where the interest rate is going. First of all, I can tell you right away, I think it's going down. I think it's going to go quite quickly. And in this video, I will tell you why. First of all, why is it important? Well, the interest rate is important if you are an investor in stocks or in currencies basically also, but in stocks that is the focus today. And the reason why I'm saying that, in this chart we can see that we have the Fed fund rate, that is the interest rate that the Fed in the United States are dictating. And we know that this has a huge effect on the stock market. Now the blue one here is the Fed fund rate, and this brown orange line is the S&P 500. It's not that there is a one-to-one correlation or inverse correlation between the two, but we can see a clear connection between when interest rate drops and then stock markets going up. Now, if you're looking at this chart, you can also see that there are times when the market is actually going up while the interest rate is going up. And that's why I say it's not a one-to-one connection here. One of the reasons why there is this little disconnect is, let's have an example here. We can see that the interest rates were turned down to basically zero after the financial crisis with the QE packages and so on. And we saw that the interest rate was just staying at an unnatural low level for a very long time. The market went up like crazy, we all know that, and then the interest rates started to go up. Now in 15 we had a very rough market, and that was because the market started to anticipate that Fed would do a bit like this. The Fed came out with some announcements. They are good at hinting and putting some wording into the speeches. So 2015 was a year where the investors were basically just waiting for this to happen, which gave a lot of volatility and uncertainty. Then they started to rise the interest, hike the interest rate here. And even though they did that, the market actually went up. Then you could say it's not only the interest rates. For instance, in February 17 here, Trump became president, which means that we had a huge tax relief package where the big companies had a lot of tax cuts, which meant that the stocks were going up because many of these companies were actually buying back their own stocks. That is another story, but it's just to say that the stock market is not only dictated by interest rates. Then interest rates kept going up and up and up, and if you were an investor back here, you know that in Q4 in 2018 the market started to drop quite dramatically, 20%. And Trump went out basically once a week approximately, threatening to fire Powell, the head of the Fed, if he didn't start to lowering the interest rates. And here in the Christmas days in 2018, Fed came out saying basically, yeah, sometimes in 2019 we will probably start cutting the interest rates. And just the announcement made the stock market go up like crazy. Then, of course, we had the Corona crash here, and in that connection, the interest rate was sent down to zero again. We stayed there for a long while the market went up over 100%, and then Fed finally started to hiking the interest rate again, and did it in a massive manner that haven't been seen for a while. So now we're here. We are seeing a break in the rate hikes, and Fed have basically announced that this is it. No more rate hikes. Now where do we go from here? Well, first of all, let's look at it just in the recent history. If we go back here to the top here, the interest rate was around 10%. When Fed started to cut the rates, over a 2 to 3 year period, the interest rate went down by 7-8%, something like that. Then we had a bit of a mess here, where there was a bit of cuts and hikes and cuts and hikes. But here, and this was with the dot-com crash and the following recession, we saw a cut from 6.5%, and over a couple of years it went down to approximately 1%. Then it went up again, and with the financial crisis we were at an interest rate around 5.25%. When they started to cut, it went down to 0. Then they started to hike. When they started to cut, it went from 2.4 to 0. And now we are at a point where if we should follow the pattern from the last 3 or 4 rate cuts, they would start cutting. I don't think they will start cutting down to 0, that unless we are seeing a massive recession. But a move down to between 2 and 3% will definitely be a possibility. And I think it will be fairly swift. All right, let's see what else we can look at. When we are looking at, well, these were the fund rates. We don't have to look at them again. But let's have a look at the market, what they think and what the Fed says. Because if we are starting with the Fed, we are looking at something called a dot plot. A dot plot is each of these dots are showing one member of the Fed. And this is where each member think the interest rate will be at the end of 2024. This shows where they think they'll be at the end of 25, 26, and so on, and then longer run. The hike in stock prices that we have seen just lately, this hike here in the autumn of 23, sorry, that was here, in the autumn of 23 here, that has been caused by the change in the dot plot. Because before that, before the last interest meeting, this dot plot was skewed a lot higher. But all of a sudden, we could see that the average member of Fed actually saw 2024 ending with an interest rate around 4.5%. That is 3 rate cuts of 0.25% each. Because right now, the interest rate is at 5.25%. If we're looking at this one, this is something called the SME Fed Watch Tool, or the FOMC Countdown. And right now we can see that at the next Fed meeting, which is in 31st of January, the market are pricing in almost 100% certainty of just the interest rate staying at this 5.25 where it is now. This can change quickly. As you can see, this is 1 day ago, a week ago, and so on. So this is derived from the pricing of different futures and stuff in the market. But if we go out and you see here, we have a 93.3% probability of staying where we are now. If you go out to the next meeting in March, we can see that there's actually a 60% probability of 1 rate cut. There's a slight chance of 2 rate cuts and about a third probability of no rate cuts. Going out, we can see that the market anticipates more and more rate cuts. And if we are going into December meeting of 24, that is roughly 1 year from now. Remember, we are at 5.25% now. We actually see the majority of the market believing in either 5, 6, or 7 rate cuts by this time next year. So that is one of the reasons why I am fairly certain that we are going to see some massive cuts in interest rates. Now, does this make sense? Yes, it does, because one of the reasons why the Fed hiked the interest rates as much as it did was the inflation. Here we have the CPI, Consumer Price Index, which is the normal consumer inflation. And we all know that after the massive pumping of the money after the Corona crisis with stimulus packages and all that stuff, the CPI went up and was actually up touching 9% year over year, which was massive. We hadn't seen anything like that in 40 years. And after that, it started to come down. Right now, it is at roughly 3%, but it is actually lower. If we're looking at something called trueflation, and up here choose the US inflation rate, we can see that the actual inflation right now, this is a website that takes all sorts of consumer prices directly from the internet and calculates the actual live inflation. So right now that is just above 2%. And the only reason why it's actually that high is that it has housing shelter in here, which is going down, but is going down a bit slowly. And that is a big factor in the overall inflation. It counts for almost a third of all the inflation prices. So with a housing here around 5, that means that you can, if you deducted housing, no, you can't just do that, but if you did, you were actually down at an inflation around 0.5% in the United States. Now, Fed's goal is to have an inflation at around 2%, and they actually don't want it lower. They don't want 0% in inflation or even a negative inflation, even though it sounds nice that prices are going down and our goods are getting cheaper. But what it also does is that it halts all growth in society. If you're going to buy a new car at $100,000, but there's a negative inflation of 5% per year, then you could basically buy this car for $95,000 in a year, meaning that you might postpone your purchases of big items because you know you can get them cheaper in a year or so. So the government, society, they actually want a bit of inflation in society just to spur some spending of money. So right now, the interest rate is actually where we want it to be. And Fed is not interested in causing a massive recession. Although if they would keep hiking interest rates, that is what they would get. They might get a recession anyway, but they are not interested in completely breaking the economy and the stock market. So that is why I think, if you ask me, and again, this is just a guess based on some data, some stats, some charts, we will see the interest rate starts to be cut massively. Now, the inflation might start going up again. Nobody knows. So if they cut the interest rates down to 4 or 3.5%, and they can see the inflation starts to explode, well, then they might just hike again. So it's not like it's for certain and forever. But if we're looking at the last times here, it has been quite dramatic when they started cutting the interest rates. And I think we will see over the next couple of years, we will see between 2 and 3% interest cuts from United States and probably also from the ECB here in Europe. So that's my guess about the situation. You are welcome to disagree. If you have any opinion on it, please feel free to put it in the comment section below or on our Facebook pages. And yes, I just wanted to inform you about this, and also knowing that a big cut in interest rate will probably send the stock markets upwards. The stock markets have been pushed quite a lot down in 22 and a bit into 23 simply because of the high interest rates. So a big cut in interest rates now could spur some quick bull market bursts here. However, also remember that one of the reasons for a cut in interest rates could be a massive recession or a mid-sized recession, which could also put some sectors and some industries groups under some pressure. That's all for now. I hope it made sense. And until next time, take care of yourself and your money out there. Bye for now.